Thanks for joining me today, Karen.
Thanks for having me.
Karen, Bridgewater is known for its macroeconomic analysis and research. We've seen bond yields surge pretty much all year, normally an indication of a strong economy. We just got strong third quarter GDP growth. Do you see any signs of the economy slowing? And what is your general view of where we are in the economic cycle?
Well, I think where we are is that we got inflation surging to the highest levels we'd seen in decades coming out of unprecedented monetary and fiscal easing after COVID that has led to a very, very rapid tightening, the fastest rapid tightening we've seen in decades. And that there were a lot of forces that were offsetting the impact of that tightening. So typically when you get that much tightening, you're going to get a serious economic slowing, which we can get into. But what's left us today is, as you're sort of saying, a pretty strong economy that my forward projection would be is going to kind of gradually grind down, that these higher levels of yields are kind of gradually going to make their way through and have an impact on all the ways that higher rates tend to slow the economy over time, debt burdens, borrowing not being attractive, and so on. And that grind down can't really be saved by the Fed just easing, as we've kind of gotten accustomed to the last few decades, because inflation is going to remain just a little too stubbornly high, not as high as it was, but just a little too stubbornly high to feel comfortable really easing into that situation.
So you talk about the Fed. The market seems to be thinking that we're going to see cuts in the June-July timeframe of 2024. Where do you see that playing out?
I think the markets have been pricing kind of a Goldilocks perfect scenario where you don't get an economic slowdown. Look at what's priced into earnings. They're basically priced to be fine, where inflation magically comes down to exactly what the Fed wants, literally a central bank's dream, that from high levels, it just comes down without any economic slowdown, and that the Federal Reserve can kind of ease into that situation. And I think more realistic is that as the economy stays strong and just kind of gradually grinds down, you don't get enough decline in inflation to really make the Federal Reserve comfortable with really strongly easing into those conditions. So could they ease a little bit? Sure. Could they ease a lot? I think that's challenging to see that without a very significant economic slowdown. And so the rise in bond yields we've seen in recent weeks reflects the markets, I think, realizing you're going to get higher rates for longer. And that I think either is going to be challenging to get even the easing that's priced in today to materialize, or the economy will just slow more and surprise us in slowing more than expected.
All right, let's talk about that slowing. A lot of people thought we'd see a recession in the summer of 2023. That didn't happen. Is there a recession in the cards in 2024, in your opinion?
Yeah, I think odds are reasonable, but the thing that stopped the recession in 2023 is very important to understand. And when you think about how people can spend money, like what's the money that makes it into the economy, right? There are really three things you can do. You can use your income, which is the most sustainable way to spend in the economy. You can borrow, which kind of puts fire or fuel on a cycle because you're spending money you don't have. And you can use your savings, and people typically don't really use their savings, right? Because if you start using down your savings, you get up the next day, you're like, wait a minute, I don't want to do this. I'm going to run out of money. So that very rarely drives cycles. And what happened in 2023 was that borrowing collapsed, totally collapsed, as you'd expect with the rate rises. And actually spending down savings drove the economy in a major way because there was so much savings that was created with all the fiscal policy and checks being sent to people over the COVID period. And then that impact of the tightening through the borrowing slowing could be offset by that normal income cycle kind of picking up at the same time. And now that savings part is normalized, and the main person borrowing is really fiscal, right? If you look at the size of the government deficit, it's remarkable. We've never seen a deficit this big when the unemployment rate's great, when there's, really no problem in the economy. Typically, when you have this much borrowing, you get kind of a recession type economy where you get low rates, higher bond yields. That steep yield curve gets people to want to buy the bonds, and they're kind of the only borrower in town. So being in the situation with a strong economy is very unusual. And that alone could have tipped us into recession, over 2023, if you were in a situation where borrowing was collapsing, rates were rising, and people weren't willing to fund the government borrowing. But instead, for almost some mechanical reasons, a lot of that deficit got funded through T-bills and through, the reversal of the reverse repo facility. And it's a very unique situation to America. Most people don't, fund, you can't get Brazil funding in 3-month money at a huge deficit. But we're only now in 2024 really going to experience for the first time, what does it take to get investors to want to fund the size deficit? And that's the start of the move we're starting to see in the bond yields. And so I think most likely that's more of a grind down than like a rapid recession. But these things can build on themselves. And eventually the fact that you can't ease just changes the game from the one we've gotten familiar with, where any slowdown gets immediately reversed.
So you're thinking more of a grind down, slowing economy as opposed to an actual recession is more likely in 2024.
I think that's more likely. And I think you're already seeing what that feels like in Europe and the UK, where it feels this sort of like malaise, stagflation. The economy is already not awesome, but the level of activity is high. So you don't have a lot of unemployed people, but the growth rate isn't very high. And so the central banks, they're also saying, but inflation is kind of sticky and stuck where it is. And without getting a real recession, that's not likely to reverse. So they're kind of stuck in this stagflationary-ish period where no one really wants to tip the economy into a rapid recession, but that's probably what's needed to get inflation really to be less sticky. And you're kind of stuck with slow growth, but at a high level of activity.
Got it. So what do you think that means for U.S. stocks if there's kind of like a not really stagflation, but something that might approach it?
I think U.S. stocks are pricing in perfection because what's happened is the U.S. has just outperformed the world for so long, right? It's been such an incredible run for stocks. And so as usually happens when you have an amazing run, that run usually starts with very low valuations. And then when earnings are good, it surprises on the upside, but then that gets expected into the future. So when I look at US stocks, I actually see pretty reasonable expectations of earnings. In other words, I don't think companies are going to struggle that much because I don't expect growth to be a total disaster. They're not amazing. I think prospects are okay. The problem is that's already in the price. Valuation already reflects that. So it's just much easier to get a downside surprise. Whereas in other parts of the world, there's much weaker earnings expected. It's just not already valued. It's not already in the price. It's just much easier to outperform.
So you're not bearish on US stocks, but not particularly bullish either.
I'm definitely a little bit bearish on US stocks,
Okay.
and I especially don't like their valuation relative to other opportunities around the world. If you look at what's happened, US especially tech companies have been on such a runaway success that if you're a global investor, you're definitely thinking somewhat about the index and investing somewhat according to the index. Maybe 80% of what you're holding is in the US. And so on the way up, that really supports US stocks. But at some point, what are you going to do? You can go from 60 to 80, you can go from 80 to 100 and hold no other stocks anywhere else in the world. So at some point, you kind of have to have some degree of balancing around the world. And I think that makes the US vulnerable over time.
And so where are those opportunities outside the United States, in your opinion?
Every time I talk about Japan, people look at me like I'm stuck in the 80s, but especially because investors just ignored that country for so long and just have not been buying, not stocks, not bonds. Bonds were all bought by the Bank of Japan, such that no one has seen a Japanese bond in many years. And the stocks were stuck in this place where companies just didn't think a lot about returning money to shareholders. And so it wasn't really, didn't feel like an attractive place to really get a yield. I just think you have some of the best valuations because of that history of that success not already being priced in.
Warren Buffett kind of seems to agree with you. But what about the demographic situation in Japan? Can that support a rising stock market?
Well, I think the growth level in Japan is going to stay mediocre, but the success of buying a financial asset really depends on what's the expectation that you're buying it priced in. The average Japanese company sells all around the world, doesn't only sell in Japan. And the mediocre growth prospects of Japan are already priced in. I mean, you can expand that also to pricing also has Europe kind of being a disaster forever, right? And Europe undoubtedly went through a real competitiveness shock when Russia invaded Ukraine. That's legitimate. There are real businesses there that are going to be less competitive because they're in Europe. And I see a lot of competitiveness challenges in the medium term for Europe and demographic challenges and all that. But markets know that. And if anything, are really pessimistic, that's going to be the only thing that matters.
Karen, what are the key risks you're seeing as having the potential to have the most tangible impact on the global economy?
Well, look, I mean, the war that has started in the Middle East is clearly a tail risk. I don't think it's a high probability risk of expanding into a very significant regional conflagration, but it's clearly on the table, right? When you have as much, changes in where the U.S. has its weapons and whatnot, it's on the table. It's on the table in a real way. I don't think it's a very high probability. We're lucky that the global oil market, which is kind of the more immediate place where this kind of thing has hit in the past, is significantly more diversified than it used to be. And so it's harder for kind of, one producer going offline to have quite the same impact. And in particular, the U.S. is not a net oil importer anymore. So the ability to pressure the U.S. in particular is different when it's not an importer anymore. But you still have a lot of the world's production concentrated in the Middle East. And if you get a more significant regional conflagration, you could clearly get an impact on the oil market. And then more broadly on global risk premiums, I think that global markets are still processing the fact that we're in a different geopolitical environment where there are a lot more tensions because we've come out of, 40 years of basically relative world peace. And so you can definitely still get a risk premium move in response to an expansion of that conflict meaningfully.
Karen, you've had a very meaningful transition at Bridgewater. Ray Dalio, the kind of iconic founder of the firm and mentor to you and others, has kind of stepped away. What's that process been like? And what can you tell me about where Bridgewater is right now?
I think it's been incredible. I think that very few people in the world have accomplished what Ray has accomplished, which is setting up an institution and actually successfully transitioning it to another generation of principals. Many have tried; it's very difficult to do, and Ray deserves tremendous credit for that success. Bridgewater is made of people like myself that have been inspired by Ray, mentored by Ray, continue to be mentored by Ray, but have that fire of feeling like, the mission and the vision has really, moved on to us in our generation to safeguard it for the next 40 years, as Ray has, for 40 years before us. And it's exciting, and it's not accidental. The people doing it have been together for a long time. I think myself, Bob, and Greg have worked together for, close to like 100 years bilaterally if you start adding up all the years. Let's
not add the hours.
Many hours that we've spent together, and I think it's a lot of excitement to figure out how to build on the incredible legacy that Ray's given us.
Karen, thanks for taking some time with us today. We really appreciate it.
Thank you.